If you're planning to buy a second home or an investment property in Newark or anywhere in New Jersey, you may have noticed something surprising. The mortgage rate is higher and the down payment requirement is larger. And many buyers immediately ask, why does the bank charge more if I'm buying another property? The reason comes down to risk. Because from a lender's perspective, the biggest risk is not the property itself. The biggest risk is which mortgage a borrower chooses to pay if times get tough. Today, I'm going to explain why second homes and investment properties have higher mortgage rates, why banks require larger down payments, the difference between primary homes, second homes, and investments, and a simple question lenders ask when calculating risk. By the end of this video, you'll understand how lenders view real estate risk. In mortgage lending, there are three main occupancy types: your primary residence, a second home, and an investment property. And each one carries a different level of risk for lenders. Let's start from the safest category. A primary residence is the home you live in full-time. This is where you sleep, raise your family, build your life, create memories. From a lender's perspective, this type of property has the lowest risk of default. You ask why? Because people will do almost anything to keep the home they live in, which is why primary homes qualify for the lowest mortgage rates, the lowest down payments. Programs like FHA with 3.5% down, conventional loans even allow 3% down in certain situations. Because historically, borrowers prioritize paying the mortgage on the home they live in. A second home is a property someone uses occasionally. For example, a beach house, a vacation home, a weekend property. Second homes are considered moderate risk because if someone runs into financial trouble, the second home payment is often the first one to go. That is why lenders typically require higher credit scores, 10 to 20% down payment, slightly higher interest rates. The borrower is financially stronger in most cases, but the emotional attachment is lower than a primary home. Now let's talk about investment properties. These are properties purchased strictly for rental income or profit. Examples include rental homes, small apartment buildings, flip properties. Investment properties represent the highest risk category for lenders, which is why they require larger down payments, higher interest rates, stronger borrower qualifications. Typical down payments for investment properties are 15 to 25% down, sometimes more depending on the loan program. And the mortgage rate is usually higher than a primary residence. Now here's a simple question lenders use to measure risk, and it's something every borrower should think about. Imagine this scenario. You own two homes. One is the house where you live with your family. The other is your investment property. Now imagine something unexpected happens financially, and you can only afford to make one mortgage payment this month. Which payment are you going to make? The home where your family lives or the investment property? For most people, the answer is obvious. They will pay the primary residence first. And that is exactly why lenders price mortgages differently depending on occupancy. Down payments also reduce lender risk. The more money someone puts down on a property, the more financial commitment they have invested in it. For example, if someone buys a $500,000 investment property with 20% down, they invested $100,000 of their own money. That financial stake significantly reduces the chance they walk away from the loan, which is why lenders require large down payments on properties with higher risk. Mortgage pricing is influenced by something called loan level pricing adjustments. These adjustments factor in risk elements like credit score, loan to value, property type, occupancy. Investment properties receive pricing adjustments because historical data shows higher default rates. That adjustment is built into the interest rate. Let's look at a simplified example. Primary residence purchase, loan amount $400,000. Interest rate example, 6.5%. Now the same borrower buys an investment property. Loan amount, $400,000. Interest rate might be closer to 7.25 to 7.75. That difference exists purely because of risk factors related to occupancy. None of this means investment properties are bad. In fact, real estate investing has created millions of wealthy individuals. But investors should understand that lenders price loans based on risk probability. And investment properties historically carry higher default risk than primary homes, which is why financing terms are structured differently. So, why are mortgage rates higher for second homes and investment properties? Because lenders always evaluate risk. And when borrowers face financial pressure, the mortgage that usually gets paid first is the primary residence. Understanding this helps buyers make smarter decisions when financing real estate. If you're planning to buy a second home or an investment property in New Jersey and you want to understand what down payment you'll need, what mortgage rates look like, and how lenders evaluate risk, check the link in the description. I'll walk you through the numbers personally. No pressure, just real mortgage guidance. If you found this video helpful, like the video, subscribe to the channel. And next week, I'm breaking down how investors in Newark are using multifamily homes to build wealth. That's a strategy every buyer should understand.